What's up, everyone? Welcome to another video. I am Edward. I'm the owner of Forex XL, Invest in XL and Crypto XL. If you want, go check them out on Instagram. Welcome to this video. We are going to talk about how to determine if a market is tradable, how to actually understand if we can trade a certain pair, how to create our watch list, and also we will do a recap of a trade that I entered yesterday. It was also sent to the VIP channel and also to my free Telegram channel, which is the gold trade. And I will show you how we entered and how we closed the trade at 1-to-2 restored ratio, and how I closed an extra trade that I entered on gold at 1-to-8 restored ratio. So you can actually see how I'm entering and executing these high restored ratio trades. All right, let's get started on GBP, JPY, just to give you a general understanding. By the way, I just sent a signal to the VIP channel this morning, and this is the signal right here. Let me zoom in. It's actually the only signal I sent today. It's this one, it's running. If you don't believe it, let me just pull up the screenshot right here. Let me show. All right, VIP channel, whatever. We closed Euro USD almost at entry, and then I was looking for gold sells, didn't line up. Therefore, I checked out GBP AUD, which was on my watch list, was very interesting, and we entered this trade, sent the analysis and everything. All right, just for proof or whatever. Let's get started actually with the video. It's running nicely actually. I will monitor it during this YouTube video. All right, how to determine if a market is tradable. For those of you who don't know and who are new to the markets, or even if you've been trading for a long time but you're not comfortable and you just don't know about these concepts, we need to focus on market structure. There are certain structures that are tradable, others that are not. Now, let me delete all these things that are just making the chart very, very messy. One sec. Okay. All right, perfect. Now, market structure will make you understand where we are possibly heading, and also if it is time to actually trade the market or not. Now, by this, I mean that, first of all, let's start understanding market structure. As you know, we are either trending to the downside, trending to the upside, and these are very basic stuff, all right, or consolidating. All right. Now, we don't want to trade consolidations. At least I don't want to trade it. And in general, I don't recommend to trade consolidations, as you get a very tight range. And also, you know that there is liquidity above and below them. If you don't know how liquidity works, go and check my liquidity video. And also I will make some new videos, so make sure to stay tuned. There is liquidity is very risky, as we just might grab liquidity in each side before moving, and therefore it becomes risky trading ranges. Now, on trending markets, we are creating highs and lows. We need to notice which way we are creating these highs and lows. For example, on a downtrend, we are creating lower highs and lower lows, lower highs and lower lows, lower highs and lower lows. And then on uptrends, we are creating higher highs and higher lows right here. Now, let me show you. For those of you who are new, you need to look at the single lows and highs that we are creating. So basically, you take the high, then we are creating a low, then we are creating another high, which is lower than the previous one. Then we are creating a new low, which is lower than the previous one. And then, therefore, we just understand which way we are going. This way, we are going to the downside, creating lower lows and lower highs. This way, we're going to the upside, creating higher highs, higher low compared to the previous low, higher high compared to the previous high, higher low compared to the previous low, higher high compared to the previous high. Now, this becomes a little bit more complicated if you start asking about timeframes, because of course we need to understand that the market is fractal, and we need to take a reference for understanding the direction of the market. Of course, if we go on the 1 minute, the market structure is always changing. It's just going crazy. And of course, it is not as easy to understand the direction of the market. You can understand the direction for the next, I don't know, 2 minutes, but you cannot understand the overall direction of the market. Therefore, you need to start and take a time frame as reference. There are people who take the 1 hour, there are people who take the daily, the weekly. It depends on which type of trader you want to be. If you want to be a swing trader, an intraday trader, a scalper, or whatever. Now, for me, I'm an intraday trader. I prefer the 4 hours and 1 hour. Now, if you drop down to lower time frames, you might see the 15 minutes create something like this. All right. And therefore, we start having a substructure inside the overall structure. So the overall structure, which is the red one, is, let's say, the 4 hours, is bearish. Lower lows, lower highs, lower lows, lower highs, lower lows. Then a lot of people start getting confused because they're like, okay, but on the 15 minutes, we're creating a higher high right here and also higher low. So we're going from lower low, lower high, lower low, lower high, lower low to a possible higher high, higher low, and higher high. And then we change again, lower low, lower high, lower low, lower high, lower low. And then we start changing again the trend with some higher highs, and we reverse again. Of course, as we drop down to lower time frames, we are changing the structure more often. Now, as I said already, it depends on you, on which type of time frame you want to take to actually understand where we are heading. Of course, if you want to look at all the time frames, you will have the weekly, which is bullish, the 4 hours, which is bearish, the 15 minutes, which is changing every 2 hours, all right? And I don't know, the 1 minute, which is changing every 10 minutes, all right? So of course it gets more and more complicated if you don't know which time frame you have as reference. Same thing for the uptrend. Of course, we are changing many structures going up, and then we might change and then continue up, right? This is still a bullish trend, right? Let me delete the red one. Let me just show you. This is still a bullish trend, all right? Just because there are lower lows and lower highs right here doesn't mean that we're not bullish, okay? And the green one is always a lower time frame, just to make it clear. Now, how to understand if a market is tradable? We already say that we don't want to trade consolidations, as it's not easy to understand the direction of the market. So for example, right here, I was not looking for any trade on JPY as we were consolidating, and the direction we were having some type of direction with some, you know, lower lows and lower highs right here, okay, but still overall consolidating. So I was not really looking at any trade right here. Now, as we take a direction and we understand where the market structure is breaking and so on, we can understand actually where we want to trade. So for example, here with this move to the downside, we are breaking this structure, we are breaking this structure. So this move is really changing the structure of the market, retracing to the upside, and then we can find entries, and we know already in our minds that we are looking for sells because our bias is bearish, all right? So this is the first step that you should have when you are trading. You start from the chart, you're understanding which phase we are in, and after that, after you go on your time frame of reference, you look to follow that direction, because statistically it is proven that by following the possible direction of the market, the current direction of the market, you have more chances of being profitable. We cannot know, we cannot know that we are reversing from here. It is not predictable that we are reversing from here. Maybe you try to catch this reversal, but you enter a sell right here and you go in a loss. Then you try to again catch the reversal from here and you go more into a loss. Then you try to catch the reversal from here and you go more into a loss, and then it's just margin call and you lose all your money. But we don't want to do this because we don't have any indication that the market is reversing from here. There is no reason to just try to predict the market. We try to follow it. We try to follow what the market is doing. Basically, we try to follow what the institutions are doing with some smart money concepts. Now, quick parenthesis, we need to keep in mind that, and I know that I say this in many videos, we are not, just because we are using some smart money concepts, we are not trading like the institutions. Because I see many comments under my posts or whatever that say, oh, if you don't trade with smart money concepts, you don't know how to trade. Or let's see, I use smart money concepts, therefore I am trading like the institutions. Okay, we are not trading like the institutions. Nobody is trading like the institutions except for the institutions. All right, except for them, nobody else is trading like the institutions, because they are the only ones with a type of capital that just allows them to actually trade that way. For those of you who don't know, they usually use hedging and they usually mitigate the risk. This is not just something that I'm telling you. I actually went and read their trading reports for HSBC Bank, Bank of America, and a couple others. And they explain in some ways how they mitigate the risk and how they manage their trading. They also share how many trading days they closed in a loss, how many trading days they closed with wins, and that was pretty crazy. There was one bank, and I don't remember which one, but I will tell you on the next video, which closed, I believe, 99% of the days with profits. I don't want to say 100%, but maybe 100%. It was something crazy. While other banks, other financial institutions closed about 85 to 90% of the days, of the trading days, with wins, basically. And then they were explaining how they were trading. And basically they say that they use hedging and they use mitigation of risk. Mitigation of risk means that they have both buys and sells position open. So let's say here they have both buys and sells, buys and sells, buys and sells, buys and, oh well, actually wait, this is not the correct place to do the example. Let's put it here. Perfect. Now here they have both buys and sells, buys and sells, buys and sells, buys and sells open. All right. Then they push the market into one direction. I will just do it quickly. I will just explain it quickly without, going really into depth. They push the market into one direction, and we can notice that this is an institutional push because of the size of the candles and, just the quickness and the size of the candles. Basically, this is an institutional push with very huge momentum, huge volume. And therefore, let's understand that they had both buys and sells position open right here. They push the price down, and their sell positions are in profit. They are winning, all right? But their buy positions are not in profit. They are in a loss. They are in huge drawdown, which for them is not huge, of course. And then what happens? They push the price back up to mitigate the risk, and this is what mitigation of risk means. And I know a lot of people talk about mitigation, but this is actually what mitigation is. We come back to that area where the drop originated, and this is why also supply and demand works. They exit their buy positions, which were in a loss. They close it at entry or whatever, maybe slightly in a loss, maybe slightly in profit. And then they can finally continue pushing the price down, all right? And of course, we continue to the downside, creating new lows, new lower lows and lower highs. This is what mitigation of risk is. This is how it works for them. Now, going back to what I was saying, we are not trading like the banks because we don't have the capital to be able to do that. Therefore, we are not trading like the banks. What we try to do is follow the footprints that they are leaving behind, okay? So what they are telling us right here is that the market is breaking structure, to the downside with a very, very big push, which we think that is an institutional push given the momentum and also the size of the candles. And therefore, we want to follow this direction that the institutions and the banks just decided to take. We need to wait for a retracement, we need to find a good entry point, and then we can enter to follow the direction that they have already taken. So they are the first ones to actually move the market. We cannot predict which way they will move the market. And after that, we try to follow what they are doing, okay? And of course, here we had our nice area of supply, which was manipulated to the upside. Possibly on lower time frames, we can see some Wyckoff. Let's see. All right. Yeah, not very, very nice, but still. Yeah, all right. With our nice consolidation. Here we had the last push to the upside, grabbing some liquidity. Usually I like to see a bigger grab of liquidity, a bigger spring. Here we didn't really have it that way. Here we have our first break of structure, which is closing below the body of the candles, but I usually prefer to see actually breaking the price breaking below the wicks also and closing below the wicks. So no entry. We come back. Here we can have some risky entries, of course, if we want to, with very tight stop loss. Anyway, I will still wait. And here we finally have the breaks of structure right here to the downside with this move starting to retrace. Here we're leaving behind the last supply, which is smaller right here. And of course, if I go on the 1 minute or even 15-second time frame, which we can go and check it out, there's probably a better entry right here with even a smaller Wyckoff, with the push to the downside with the retracement and test of this possible spring that was created. We don't know. I'm not going to go on the 15 seconds right now. Possible entry right here for a push to the downside. Now, on your possible entry, you could have just a very, very risky stop loss just above this high right here. Let me show you this high, okay? Or a more conservative stop loss above this high. One sec. Above this high right here, okay? And of course, we had a very, very nice drop. Anyway, in order to understand if the market is tradable, I don't want to see a ranging market. I want to see a market that is trending, that is giving me a direction, and then I want to follow that direction. And of course, if that direction is given by the institutions, even better. Now, I just put this as a 1 to 8 because I would have closed at 1 to 8, but of course, this became a 1 to 25 or even more, but I want to keep it realistic. I would have closed at 1 to 8 in this case. Then let's notice what happened. We have break of structure down here, all right? So this move to the downside is breaking structure, previous structure, retracement to the upside, supply level, which wasn't touched. If we don't touch my level, I don't enter. Doesn't matter, we miss an entry. I have many other pairs where I can focus. Anyway, this was just to show you that break of structure makes you understand better where we are heading. If the structure is not clear, you don't want to necessarily enter that pair. You move on to a pair that is showing better structure, okay? Came back to the upside, didn't touch our area, therefore no entry. Continuation to the downside, more breaks of structure. Right here, another break of structure to the downside. Therefore, we need to focus on supply levels that we have right now. We have this one. We have a higher one, and so on. And of course, we need to focus and monitor what the price is doing at these levels in order to actually understand if we want to enter. By watching this move, I can already see that I might want to wait for my higher area in order to enter, because at this price, the price is not really discounted. This is another concept that I might cover on other videos, but of course, all of these concepts are covered into depth in my course. So if you want, link is here below, just in case. I don't want to do too much promotion, but if you want to join, there's my course actually here. And all right, let's continue. I want to actually show you the trade from yesterday, which was sent to VIP and also to the free channel. All right, we have, sorry, I know there are a lot of things. I will explain everything right now. We had a bullish trend, right? You can see clearly higher highs and higher lows. Finally, we have this push to the downside. This push to the downside is breaking the structure, right? We are breaking the structure to the downside. I waited for a retracement. I had my supply area right here. We also had some imbalance, but I will not cover imbalance concepts right now. Also because I use it my own way. It's not like I just take the concepts and apply them as everyone is applying them. I, of course, took some concepts and I am applying them in my strategy, my own way. Anyway, I was waiting for the price to align. We have equal highs right here, a lot of liquidity to grab, big push to the upside. I love to see this big push going inside the supply area, which is basically even better for me because a lot of people are getting scared of the big pushes and they will not enter. Now, big push to the upside, grabbing liquidity, perfect. I waited, went on lower time frames. Well, actually, first position was just entered right away. Once we pushed to the upside, first position was entered with conservative stop loss above the supply. Take profit was lower, but it was closed right here. 1 to 2. Sorry, they are ringing on my door. 1 sec. All right, I was sorry about that. I was saying went on lower time frames, and actually first position was entered right away right here. We just pushed inside my area. I was pretty confident because of my overall analysis. I'm not showing you everything. It's not like I'm not only looking at market structure and entering that supply or demand. There is a lot more to it, and you can see it if you just go and try it out. How, you just enter at supply and demand is not enough. You will see that by backtesting. Anyway, entered the first position right away. I was pretty confident on my overall analysis, which ended up being closed at 1 to 2.2 restored ratio, which is not that much, but still good profits. Second position, I waited and we had a nice push to the downside in profit, which is a minor breakout structure on lower time frames. We also had actually 2 breakout structure also right here, another breakout structure, retracement. Actually, I have to go on 1 minute to actually show you. All right. Retracement, and I marked my last supply area right here at the top, stop loss above it. And keep in mind, always leave a small stop loss, because a small space above your area, because we might wick above it just by a little bit. So if you put it just right there, could be very, very risky. I just give it a little bit of space every single time. I entered right here, extra position actually at the beginning of my supply, and had actually a nice push to the downside. Went a little bit into drawdown, but of course that happens when you operate on lower time frames. Went to the downside, closed at, okay, not actually 1 to 9, I closed it at 1 to 8, 8.5 maybe, whatever. I just remember it was a 1 to 8. And yes, that's pretty much it. I hope you understand what I was doing. Of course, there is a lot more to it in order to enter the trade. This is not just supply and demand. As you can see, there are many other things. Also, we were considering some trendline liquidity, which needed to be grabbed lower. And well, if I held it right now, it would be a 1 to 15. I didn't. I was happy with a 1 to 8 and closed it. And today I was looking again for gold sells. My entry was right here. In fact, I have the alert, but we didn't reach it, therefore no entry. But let me say, I hope you liked this video. I hope you found it helpful. I did a quick a recap on the gold trade, and also I just explain when and why the market is tradable. If you did like it, leave a comment or whatever you want, leave a like if you want to. Thank you for watching. If you want to join, there is my course or VIP or mentorship, you can decide on my website. The link is here below. There is the VIP channel where I share all of my trades. Well, actually not, I will say 95% of my trades are shared on the VIP channel. So if you want, you can join right here. There is the course. If you actually want to learn how to trade, this is always my recommendation, not because it's more expensive, which is not really expensive for what we actually give, but it is actually because you learn how to trade, how to use certain strategies, how to be consistent with time. And also you get lifetime VIP included with the course. So you also see my trades. Now, recently, in the last couple of weeks, I started including in the course live trading once or twice per week with me. Basically, I have all the students that want to join. I give them the link and they can join, and we do live trading with 1 hour or a couple hours, and they can see how I actually think, how I execute the trade, how I enter the trade, why, and they ask me questions, I answer, and everything just like this. I think that it was the best choice for me and for my students, because I don't just give them the course, I can actually show them how I am applying the concepts in the course actually on my charts. And actually the gold trade that I just showed you, it was called during the live yesterday with my students connected. Anyway, and also there is one-on-one training if you want. With that being said, I'll see you on the next video. Thank you for watching.